We're here with Russ Kinnel, Director of Fund Research for Morningstar in Chicago. Russ, I'm going to start off with a broad question for you. What criteria should someone use when choosing a mutual fund?
Well, I think first you need to start with a plan. You need to understand what are your needs, what are your goals, and what are the funds that will get you to your goal. And then from there you start building up your core. Those are the less exciting but more important funds. And then from there you want to look for things like good strong fundamentals such as low costs, good management, a fund with a good track record, and then you're on your way.
What would be the qualities of some core funds? What would say just if you could only have 3 funds, how would that core look?
Well, you might say start with a U.S. equity fund, large cap fund. You'd look for a low cost fund. There's a lot of funds in that space. You can find a manager with a really strong track record. Then you might go with an international stock fund. Similar thing, you want low costs, a manager with a good firm, with a good track record. And then you'd want a core bond fund, a high quality bond fund. Costs and management are important there too. And you want to shop by returns, not yield for your bond fund.
Now on the equity side, well actually on all sides, but especially with the equities, at MoneyWatch, we make the case for indexing. You know, you've certainly got the low fees, you're broadly diversified. Do you agree with that, and are there cases where you might nudge someone toward an actively managed fund?
Yeah, I think both active and passive are great ways to reach your goals. I think in either case you want low costs, and if you do go with active, if your costs are only, let's say, 60 basis points above an index fund, then the manager is a much more modest hurdle. It's a lot easier to do that. You might go with an active fund to reduce risk. Some active funds have ways of reducing risk below an index, or you might go with one simply because you think the manager can beat the index. I think indexes, on the other hand, are great. If you can't find an active management fund that's really good, then by all means go with an index fund. There's so many good low-cost index funds out there, you've got to look closely.
Now in bond land right now, at this whole conference, we've been hearing everybody, I mean from the get-go with Bill Gross, who said Treasury bonds are a bad deal, you will lose money in the long run. If you buy an index fund that looks at the bond world, of course you're going to be pretty heavily in Treasuries. Is that a reason to go active management with bonds?
Yeah, I think it's a pretty good reason. I think the good part about a bond index fund is that the costs are so low, what little yield there is, you'd at least still get some, because yield comes to investors after expenses are taken out. But yeah, I think there is some need for some flexibility. You at least want a fund manager who can go outside of Treasuries, even if they stay with high quality things like corporate bonds. It's still probably an improvement over Treasuries at the moment.
Now at Morningstar we heard a lot of different thoughts about not only the bond world but the equity world, and nobody was really excited. I didn't hear, hey, there are incredible opportunities in this sector or that sector. What themes did you see emerge? What funds look kind of good to you based on what you heard at the conference?
Oh yeah, you're right. I think the overall theme from bonds and stocks is kind of very subdued optimism, that expect low returns. But you know, I heard some interesting things from David Poppy of Sequoia Fund, which is a great but sort of overlooked fund, despite its long track record.
It was closed for so long you couldn't get in.
Right, I think people kind of tuned it out and haven't noticed that it's open again, and it's still got really good management. I like David Daglio of Dreyfus. I thought he had some really interesting points. Tom Allen of Fidelity Advisor Midcap Growth. That's a very different fund, though very aggressive, so a niche part of your portfolio. That's not a core holding.
So finally, is there one takeaway from this year's conference that you think investors should benefit from?
Yeah, I think it's one that we're hearing from many people that they expect modest but positive economic growth and sort of modest but positive returns from the markets. So I think it means U.S. equities are kind of the neglected spot, and therefore may be a good spot to invest today.
Okay, and I guess be patient and don't reach too far for yield.
Yeah, that's another theme we're hearing, is be long-term and don't expect to have great results just because you had them last year.
Russ, thanks very much for being with us.
You're welcome.
And thank you for watching.